Dr. Roger Miles.
Thank you very much. Excellent. So, in my role as sort of resident psychologist for the banking industry, I'm not going to pry too closely into the panel's inner secrets, but we do have some issues, it's fair to say, about downside risks. There's a whole lot of new downside risk out there. Rather than me trying to explain all about that, we're going to probe the considerable experience that we have on the platform here, and let me just give a couple of words to introduce each. GAIL, the cause. 25 years working with a variety of global asset managers, UK and Europe, has driven major business change programs worldwide and new regulations on sustainability and risk management. Now working with audit functions in the City of London, guiding audit and risk management. So quite an interesting public body perspective here. SONJA, LAUD, familiar I'm sure to many of you, Chief Investment Officer at Legal & General. 2 decades in asset management, has worked with FTSE 100, DAX 30 and unlisted companies. Huge expertise in investment management across all asset classes and financial markets, macroeconomic policies, corporate strategy, governance. We could go on, but we'll hear more. Deep understanding, most importantly, of regulatory changes and the business of risk management. Jeremy PESSEMIER from the World Gold Council, one of our major backers today, heads asset allocation strategy with the World Gold Council. Big experience with global multi-asset management investment strategies and solutions. Robust record of published research. Always good to have one of those on the platform. Brings us deep knowledge and skills in asset allocation, macroeconomics, systemic strategies, and ESG elements of portfolio construction. Last but by no means least, Thomas SHEEDY, Global Head of Fixed Income Risk at Invesco. He's about to complete a decade there, specializing in and leading portfolio and fixed income risk profiling. He's led financial service businesses for more than 15 years, runs risk analysis for major global asset management groups. So trying to get about 100 years of experience into a minute and a half there. Let's get cracking and talk about the downside. So let's open up with a simple sort of introductory piece. What approaches are available, and indeed what is a desirable approach for a socially responsible investor who's looking to limit downside risk? Gail, should we take the wide picture first, and then we can go into disciplinary details?
Sure. Thanks, Roger, and thanks to Adrian for having me speak here today. Before I get started, I did want to say, although I am associated with the City of London Corporation, the views I'm going to express today are indeed my own. Taking a look at downside risk, and starting out first, Roger, on your question with regards to socially responsible investors, I think we need to broaden it out because we're talking about social, but we're also talking about environmental as well as governance. When you're looking at that, and from the perspective of a large asset owner whose assets may or may not date back to William the Conqueror, you think of a lot of...
You're talking about real assets, trees.
Real assets,
yes,
yeah.
Yes.
So things that might be owned by an investor such as the City of London, and perhaps investors in the audience as well. The City of London owns 30,000 trees. So you've got these assets, and although a lot of what we might be speaking about today is financial assets, you've got physical assets to consider as well. When you talk about trees, Adrian mentioned, for example, some of the fires. I was just in New York, parts of Upper Manhattan were on fire. We're used to California being on fire, but not Upper Manhattan. I think that's one point where we might thank the rain in the UK for not causing a problem to Hampstead Heath, say. But it's something real, and it's something that's actually happening, and that's what we've got to consider when we're thinking about downside risk. It's downside risk from a financial perspective, but as well as from a physical perspective.
And there's a whole residual risk issue with that as well.
And then you've got this residual risk. And then what are you going to do with this residual risk? You're going to try and manage the risk, mitigate it to the way that you can, but what's the City of London going to do? Offload Hampstead Heath onto somebody if it starts getting too hot in London? What's New York City going to do with Inwood Park? Same thing. So I think it's something to keep in mind as we have these discussions today, because it's not just assets that we in the room or the companies or firms or investors that we represent can trade away.
Sure.
Some of it you're going to maintain over time.
Let's take the investor perspective. So Sonia, I know investment risk is your primary concern here, but of course it feeds off into different directions. Maybe a couple of thoughts on that to open.
Yes, absolutely. I always like to take a step back because it's first and foremost, what is downside risk? If I ask 10 people in the room, I might get different views on what means downside risk to you, because at the end of the day, it's the individual's appetite for risk that will drive that perception. Now, in the good old days, of course, it was a two-dimensional risk-return matrix, and we were able to assess, depending on the risk appetite, how the downside risk can be mitigated. Now, in the context of responsible investing, we have added a third dimension, because we are increasingly seeing that investors would like to add a real-world outcome to the two-dimensional matrix. Now, that in and of itself, you can understand if you try to optimize a three-dimensional problem statement, is ever more complex compared to the two-dimensional. And this is where it comes into understanding as an investor what you would like to achieve. It is very important to understand financial materiality, because we know that some of these factors we're aiming to integrate in our assessment of financial assets. And by the way, very often financial assets incorporate real assets, right? If I understand a company, I need to understand the physical risk versus the financial or transition risk. And as such, it's very important to understand what the outcome is you're trying to achieve. And again, this is first and foremost, I always like to make the point, as the financial services industry, as an asset manager, our purpose is to deliver credible investment solutions for our clients to achieve their financial needs. That will not change. But what we are seeing is that third dimension, that clients are very willing and very clear that they would like this outcome being added to it. And that means you need to understand trade-offs as well, because inevitably, if you try to optimize against three different dimensions, there will be trade-offs. The simplest one is exclusions. If you do have a climate goal, you will most likely tell your asset managers, I do not want to be invested in coal. Very often oil and gas is an issue, and you will have other areas to exclude. That limits the investable universe. So there is an understanding that downside risk will shift the more limits you will put on the investment manager. And it's that understanding that is incredibly important. Now, can you hedge these? That's the typical asset manager, i.e. can you protect against these? Very often it's very difficult because you have quite a clear time horizon mismatch between potentially your financial returns and your willingness to look decades in the future to have a transition to net zero.
We'll talk about strategies
and
for that in a minute.
That's very important. But of course, in order to understand protection, it is very important how you look at the long-term return, because the more you're willing to probably have short-term downside risk, the more you will be able potentially to harness long-term returns. Diversification is still key.
The opening move here then is less about models, if you like, the two-dimensional risk matrix, than the impact, which is that third dimension, what's happening in the real world. Turning to gold, which one could argue has, I don't mean this unkindly, zero impact, because gold is just gold. It sits there and it's incorruptible. But let's talk about the investment angle and the downside on that just for a minute. Clearly, you have at your core this incredibly sustainable commodity. But there's a little bit more to it than that, isn't it? I think you can tell me a bit about Enviro Positive, for example.
No, for sure. And I suppose I'm coming at it from a portfolio construction perspective, and to echo some of the points that were made, I think there's many ways to protect a portfolio and build in some downside protection. You've got some option strategies, buying puts, for example. You've got systematic exposure management techniques which de-risk your equity portfolio as well.
I mean, as a starting point, gold is a safe haven, so there's a sort of absolutely firm foundation there, which is not in doubt.
So I'm just kind of, I suppose, laying out the foundations. There's more traditional, I suppose, de-risking strategies, which is diversification obviously being the key. And within that, gold fits in alongside high-quality government bonds, for example. And I think gold, to your point, should be seen as a safe haven asset. I think those characteristics are well established amongst the investment community, meaning that in times of heightened geopolitical risk or economic uncertainty, investors typically turn to gold for protection. So it can act as that form of portfolio insurance.
But the asset itself is, let's say, ESG positive, and I know you can make a convincing. Although we'll come back to this, and I'll give you a slightly rougher ride on this later, about what you call above ground and below ground assets, which have slightly different characteristics.
Yeah, so I think if you look at it on the face of it, an exposure to gold, above ground gold, which is predominantly held through jewelry or investment, so vaulted in a vault, that has very little impact in terms of carbon emissions, for example.
Sure.
So on the face of it, it can be seen as an ESG-friendly asset. I think there's a bit of nuance then that comes in as you go up the value chain and you look at the mining sector for sure. But we can get into that, yeah.
As indeed we will. Thomas, you've been very patient. Liquid assets, illiquid assets, strategy changes.
Yeah, I think
opening thoughts.
To sort of echo Sonja's point of view is that downside is relevant to the investor themselves and what they are trying to mitigate against. And one of the key elements of any strategy is understanding what's acceptable and what is not.
Right. And who's to say what is acceptable?
Well, ultimately, it's the investor to
Right.
define their risk appetite in terms of what do they want to do. Do they want to maximize total returns over the longer term and accept a certain degree of volatility with it, or are they looking for a smoother ride where you'll have, because you can provide that with hedging assets, but then you're going to have a drag because that costs money to have those hedges in place. And I think one of the key things is managing client expectations in terms of what is their journey going to look like.
Yes.
You can look at things like, and particularly in the sustainability place where you've got transition or buy and maintain portfolios, where the anticipation is that there will be a rough ride potentially, but actually the patience is the key. But that is ensuring that you have the investor buy-in and that they're expecting that, because it's not going to be set up in a certain way that you have the liquidity to necessarily move around.
There seem to be two kind of dynamics that we need to consider in this forum. There's the changing investor expectations. There's also the changing backdrop of market conditions, volatility and spreads. And actually, just let's hop straight into the next focus of this, that we've been talking about the regulatory definition of an acceptable return. Mm-hmm. Actually, we're going to be pressured far more, I suspect, by market conditions than regulation or indeed model making. So any thoughts on how you've responded to those aspects of the challenge?
Yes, I think one of the key elements is that when we look through sort of markets, particularly post the GFC crisis, is that actually models and methodologies will tell you very clearly where you are, but where you're
Right.
going to is actually more important. If you take today's market where interest rates are sort of back to almost textbook 5% sort of territories, but you've got credit spreads that are incredibly tight, the models will tell you that all your risk is on the interest rate side of the market. But in actual fact, going forward, if there's any sort of risk-off event, and particularly if there's an inflationary-driven risk-off event, then you're unlikely to get that correlation support from your duration assets to insulate you from the credit sell-off. And this is the point that over the last sort of 20 years, every year there's been some degree of a correlation break, rather than necessarily it's
Right.
just a classic flight to quality, flight to assets.
The other aspect of this, though, is the sheer choice of models out there, both vendor models and indeed regulatory certification. I mean, last time I looked, and this is a few months back, there were, I think, 7 different regulatory certification, approved frameworks. Mm-hmm. So there's always a risk in this kind of contested space of, let's call it regulatory arbitrage or models game playing. So I know you've been sort of pushing through that with Invesco in a different way.
Well, very, very much so. I think that everybody gets bored of me saying this, but it's like all models are wrong. Some models are useful, yes. And I think that's sort of a critical element. And I think it's one of the critical parts of being a risk manager, is that you've got to look at things and think about them from the perspective of what you haven't considered. And obviously the market has the availability of all of these different models and will interpret them in ways that they want to. And to some extent, and particularly in the sustainability world, there's so many metrics, and the correlation between even vendor providers of those metrics isn't great.
So you don't play that game of, we could call it vendor model arbitrage, which certain others
not
do,
really,
we
because
won't name.
I feel like that certainly from my perspective, I feel like that they're useful information, but particularly the sustainability models are very much baked into sort of historical reported, and by the time they're published, they're almost already sort of 3 to 6 months out of date as it is. And I think we can all learn the lesson from the same as using third-party credit rating agencies, is that inherently, if everybody just uses what's available on the street, then there's no advantage to putting your money
Right.
with active management.
And I know Legal & General have this approach of taking the best of each. So you talked about understanding a mix of priorities against the total return and looking for indicators which reflect those priorities. Would you like to tell us a little bit about the thinking behind that?
Yes, because as you very neatly put it, the model just takes you so far. And to me, the most important aspect is that I need fund managers and analysts to understand what they're doing, which means, and that sounds very simple, but if you consider the three-dimensional backdrop we're now operating in, it means a lot more around key assumptions you're taking. It requires you to have a level of knowledge and skill set around those additional themes that we did not need to discuss just 10, 15 years ago. And that's a massive shift in the requirements on how you structure investment processes. And we need to be able to explain to clients what we're doing. It cannot be a black box that you take assumptions from the outside and models from the outside without being able to explain why you have actually invested in a specific company, why the allocation you've come up with actually is aligned with the investor outcome.
You gave us an example of this, so the change of thinking from simply a net zero bottom line towards a transition. Frame of engagement.
I always like to say we're talking about a system-wide problem, so it requires a system-wide solution. Yet the way we're going about so far is small pieces of a jigsaw that actually only can work if you all add them together, but we don't do this. And the best example, I mentioned exclusions earlier. Exclusions mean that we are feeling good because we construct portfolios that on paper look like they're transitioning to net zero. The system is not transitioning at all. If you leave the dirty stuff on the side, then somebody else will still own them. You mentioned the election, and we heard the election earlier. And that means as long as the world is not aligned on where we're heading, you will always have, that's arbitrage.
We had a really interesting conversation, and just to sum, if we can capture it in 30 seconds, about different national characteristics. So a Scandinavian investor will ask you one thing, a European, Central European another, an American another. Maybe just a thought on those kinds of differences, cultural differences we might call them?
Cultural, yes, in terms
investor culture.
No, it's more the level of sophistication.
Sure.
Right, because to me, the key is, does an investor actually understand what the objective and the target is? Can they articulate this to their end clients? And how are they going about to put this in place? And with one of the Swedish clients we established actually a partnership to focus on the dirty stuff, the laggards, because they were very clear as they understand that unless we're dealing with every company and actually with a system-wide solution, we will not tackle the system-wide problem that is climate change. And that's actually a very forward-looking and a very sophisticated approach. And they want to be engaged. They want to be part of that journey. And that is not what you see very often, because sometimes it can feel a little bit like box ticking. We need to have that net zero pathway so that we can demonstrate that we're doing it, but not enough thought on actually how we're doing this so that we're combining the real world impact with the financial return.
So it's the degree of underlying commitment, and as you say, I think sophistication is a good word, that there are clearly more developed national and investor cultures. Gail, quick thought on this about legacy portfolio maybe, issues there?
Sure. I mean, getting back to the comment that I made before on the physical assets, and to Sonja's point on the Swedish partnership, sometimes you can't change what you have, so you need to work with it. You're not going to sell off all of those legacy assets, because at a certain point, who's going to buy them, right? So and I know we were speaking before the conference started about buildings, for example, and I think that's a terrific example. If everybody moves out of the buildings that are not net zero or close to being net zero, well, we don't have enough great office space in the City of London.
Map of the City of London, yes.
For everybody
That's
to be a really good building,
yes,
and not have to worry about their Scope 1 and their Scope 2
sure,
impacts from that building. And then what about the bad ones? So at some point, and this is the hard bit, right? This is the last bit if you consider it just from a net zero transition, and I appreciate what the issues we're speaking about today are broader than that. But what do you do with those old
You get a risk
buildings?
of a kind of grey market of bad money drives out good, and then there's a sort of irresponsible group who are disengaging potentially.
Well, it does depend, right? who's going to be the investors or who are going to be the companies that are looking to uplift those bad? And I don't mean bad that the buildings are themselves evil or anything like that. I'm speaking about just less environmentally friendly. Sure. But we're going to all have to find solutions for that. You know, the City of London has been putting money in to try and help turn some of those things around. But it's broader than a local authority, or it's broader than even the London authority or the UK.
Let's take our cue from that and go macro. Jeremy, you've been very patient. I know we had a fascinating conversation about the change in investment outlook, the inflation spikes, the trading conditions being fundamentally different in 2024, even to how they were in 2022 and the decade before that. Could you maybe give us a sketch of what is core protection about now, which it wasn't, say, 5 or 10 years ago?
Yeah, and I think Thomas alluded to it in the way that, I guess, the inflation environment that we saw in 2022 and 2023 highlighted, or at least reminded investors that high-quality bonds are probably not the best asset to own in such an environment. I think we've done a lot of analysis that shows that, at inflation levels below 2%, bonds do a terrific job in terms of diversifying your portfolio, but at levels above that, that relationship, in terms of that negative correlation starts to break down. So that highlights the fact that you need to own or diversify your sources of safety, your downside protection in your portfolio. And that's where we feel gold can have a role to play, alongside fixed income and other downside risk tools.
I'll pick up the spreads issue with Thomas in a minute as well, because I know that's an aspect of that. So inflation spikes, clearly good for gold. In a sense, we just ground that. And net asset allocation plans, if I could say it, always should have a look at some aspects of a core piece like gold that is not going to change fundamentally. So in a sense, volatility, a bit of turbulence is actually in your favor at this point. You gave me also a statistic that gold has held its value over 20 years at a solid 7.5% return on average.
In dollar terms.
Is that right?
Yeah, in sterling terms, if you look at...
Not that I'm here to market gold, heaven forbid, but that's quite an impressive track record.
Yeah, I think 10% in sterling terms over the last 20 years. So yeah, definitely you can participate in the growth as well. And I think, coming back to the whole macro environment, I mean, inflation is one scenario that you mentioned. But fiscal deficits, high debt levels that we see across the developed world are also, I think, a big concern for investors and can lead to credit events.
And indeed, central governments, given the state of central government needs over the next 6 months, we might project there's going to be a bit of gold buying going on. It might be safe to say.
Well, we'll see. I don't like to predict, but I think...
Far be it from us to call that.
Yeah,
absolutely. Yeah. Thomas, thank you. We were talking about, what next after free capital? What about the new rules? What about genuine competition, actually, in the light of what we were just talking about with Jeremy there? We've had the decade of free money, of low interest, of relatively relaxed spreads. Now that's all changing.
Yeah, I think that's true, and I think that where we feel is on a sort of a shift in paradigm where people have, for 10 to 12 years, people got used to sort of very low interest rates, and the search for yield was in, lower and lower quality assets, which sort of, exposed a lot of people to try and keep up with the equities that were also profiting from that period. The reality is now we're back in sort of where your all-in yields, your credit spread is sort of sub 20% of that all-in yield, and he sort of feels, well, actually the main driver of my returns is now going to be duration. If you were right on duration in the first half of this year, that will have major P&L, whereas actually credit spreads, continue to grind tighter and tighter, but actually as a proportion of your all-in sort of risk premium, that you have to ask yourself the question at this point is that, are you being paid to take that downside risk? Because the reality is that if we avoid an inflationary environment, you do have the cushion of the duration will likely help, central banks will likely help. However, if you have, with the fiscal largesse of the various developed markets coming, there's likely to be a lot more, we saw it yesterday with sort of Bank of England's inflation is sort of coming back into topic. And if that is the case, then, if credit spreads blow out and you don't have the insulation of the credit central banks to help you, then where do you look for your sort of hedging activities?
All of this, meanwhile, in a market where getting paid, as in fees, there's been nothing but downward pressure on fees. Sonia, this might be the moment to pick up on private trading. Do you want to just answer Thomas's point first?
Yeah,
yes.
Very happy, but if I may add to it, because both have now alluded to, fiscal deficits. There's an interesting development that emerging market investors would always price political risk in a way developed markets never have. Now, we could cynically say that developed market governments now move far more towards what we are used to in emerging markets. And as such, none of this is priced. You can see the way we talk. It is all about inflation and growth and of course, monetary policy reaction function. And yet we are seeing a dramatic shift to the right. And of course, the mandate that Donald Trump has been given might add a level of political risk that we've never had to consider.
I was going to say there's a downside to that, which we've not really looked at yet.
Where an emerging market investor would always
yes.
have this as a piece of the analysis. And that is fascinating because that might actually add a dimension that we are not used to look at. And we talked about tight credit spreads, the valuation levels in equities. That is a very interesting inflection point that I don't think we should take too lightly.
Can I ask two follow-on questions from our conversation earlier? So private markets and the changing nature of greenwashing.
Yes.
I don't know if we can kind of shoehorn that into one answer to this
topic.
Yeah,
I think I have to split the two because,
sure.
Of course, everything we've talked about and the idea of diversification and protection to the downside, we've heard hedging, of course, always comes at a cost. Timing is not always very straightforward. Hence, we're seeing increasingly investors looking for holistic solutions across public and private. There's a different price discovery mechanism. As such, you can smooth actually your returns. There's very often uncorrelated returns. You have longer term duration across private markets. So actually a very natural way of allocating across these two. And as such, we're seeing equally now standards being applied to real assets. You talked about property in particular, where there's much greater awareness now. Now the way you engage from a responsible investing standpoint is very different because of course the ownership very often is different and hence the way you engage. But clearly that's a topic we do see engaging further. I'm still waiting for the regulator to get a lot more interested in what's happening in private.
So there's a question of discovery, particularly there, yes.
And then adding greenwashing to it, which for the time being, as you all will know, is predominantly looking at public, right? And there's been an increasing focus that what you're saying to your clients actually is very much reflected in what you're doing. Then we come back to the different standards, the different data points, and how can you demonstrate what you are doing is actually according to the rules. And I think that will be an ongoing evolution how you do this.
And again, very much framed in terms of real-world impact rather than simply metrics.
Yes.
So it's showing the investor this is the difference that we make. And I think
Measurability.
those early sort of spats that various regulators had, and we talked a bit about, I don't know, Baffin's running with DWS and a number of greenwashing, anti-greenwashing interventions. I think we've all grown up quite a lot in the, whatever it is, 5 years since then, that actually investors are mature enough to see we want to know what we're getting, not just in terms of financial returns. Just to return to the headline topic, I'm very aware that Adrian's challenge to us was to talk about downside risk rather than purely metrics and spreads. Safe haven assets. Thomas, what would a flight to quality look like?
I think this is sort of the point I made earlier as well, is that everybody's sort of view of flight to quality is obviously to government assets and away from sort of the classic risk on, equities, etc. But I think that the reality is that, as we've discussed, that the changing inflection point of the markets is that a flight to quality isn't as straightforward as we historically sort of thought.
It's right, not just US Treasuries, and that's all fine then.
Well, yeah, not just US Treasuries and a vault full of gold.
And gold, yes.
But
I'll give gold a say in a minute, don't worry.
But I think that this is the challenge, is that what does the flight to quality look like? And I think that this is where we have to think of all of the information that we have for the recent past isn't probably the best predictor of where we're going to in the future.
If you had to predict?
If I had to predict, I think that the reality is that obviously there's a lot of insurance, if you will, in duration. I think that obviously the credit default swap market is helpful, but then, as Sonja said, the timing of that is incredibly challenging, and also it's generally a negative carry trade, so it's good for insulating your return profile, but not necessarily for capturing the returns from the downside.
We also talked a bit about the perverse attraction of equities as against fixed income, and that things have almost flipped on their head.
Yes, well, obviously, and going in towards a more inflationary environment where you've got sort of the expected yield on equity sort of 8 to 9%. But I think one of the key things that we've also seen in the equity market is actually a move away from, it's not a rising tide that's rising all boats. Rather, it's
costs,
becoming
prices, everything. Yes.
But it's also, the concentration in some of the larger indices is, 30% of the S&P is made up of the Magnificent Seven, as they're now referred to. But whereas the rest of, you can buy ETFs of the S&P less the Magnificent Seven, and they're pretty flat compared to what the S&P is doing. And even if you compare like equally weighted, there's a question around whether cap weighted indices, certainly on the equity side, are sensible, because in fixed income we've often had certainly in the high yield space, a 2% cap on individual issuers, so you don't get that sort of actually the index having a concentration bias, whereas diversification is and always will be your friend when it comes to downside risk.
Jeremy, you made a strong case to me that gold is your friend in that situation, looking at pure inflation as your benchmark, if you like, for performance. Anything you'd like to tell us about? Let's actually go dig into gold a little further. So you talk about above ground and below ground assets. Could we maybe explore that for the benefit of this audience, which may be less familiar with that way of looking at it in terms of ESG framing? From the ESG framing perspective, yeah. So as I said at the start, I think if you look at the above ground stock of gold, that has very little in terms of carbon footprint. So in some ways, I do think that it should be perceived as an ESG-friendly asset from that perspective. Then as you go up, that supply chain, obviously mining is there because gold, is an extracted commodity. I think to put it into context, though, in terms of new supply that comes on board, it's about 1.5%, a year. So it's not a huge amount that's been extracted from the ground when you compare it to what's there already. So that's one angle to look at it. And then looking at the mining industry in itself, and I think, they obviously take ESG considerations very seriously. They're making every effort to try and have a positive impact in terms of decarbonizing, for example, their supply of gold by using electric vehicles. And then I think what shouldn't be underestimated is the impact that they have on the communities in which they operate. Sure. Right? Because it's one thing saying, hey, mining is bad, it's all of that. But at the end of the day, they do operate in typically poor countries, and a mining company that arrives in those countries and that invests in infrastructure, that invests in utility, in electricity, in education, in healthcare, has a positive impact on the communities that live there. Right, and this actually brings us back to the points that GAIL was talking about with the audit questions and what is the real world performance, indeed, that we've all touched on. So actually, GAIL, let's just pick that up. Net zero is, we're all on a journey together, not just as investors, but as actually the way we behave in our lives. So, think about your pension fund or what you do at home, your consumer choices. You used a great phrase, the credibility of the plan. Would you like to tell me a bit about what that means when you go in as an auditor and maybe challenge, or indeed as the City of London, challenging your local residents, shall we say, your city groups here?
Sure. I think it goes back to the point that Sonja made before, which is you've got a system-wide problem, so you need a system-wide solution. So just to give the City of London example, when we were tendering for new external auditors, we asked all of the audit firms that were agreeing to provide the service, pitching, sorry, to provide the service, what was their net zero target and what were their plans? Because the city has a clear plan, we need all of our suppliers.
But you then interrogate that plan. That's the bit that I liked. So you don't just take what they
You've got to ask questions about it. Otherwise, it's back to the point that you made before. Then it becomes a tick box exercise, and that's really in nobody's benefit.
So what kind of new metrics are you seeing now or encouraging them to present, which weren't there, a decade ago?
I think in terms of new metrics that we're seeing, we're not going to encourage anybody else to change their plans. It's more of a question of asking people what they're doing. I mentioned before about managing and mitigating, but you can't manage what you can't measure. So when you look, we've got tons of net zero metrics that are floating around. We've got reporting on that with TCFD. We've got TNFD developed. For example, the Natural History Museum's developed a really interesting index, which I think they've put on Bloomberg now, on biodiversity. That's going to help firms and other entities measure biodiversity. On a personal view, I would expect once we get TSFD and the social reporting, we'll have other metrics that come into play as well.
You're also looking at ground level for a genuine behaviour shift, not just in terms of the portfolio asset allocation and all of that, but actually amongst, let's say, employees, people responsible for risk governance, that there's a personal commitment to live the values.
You've got to have a personal commitment, both because once again, it's back to the system-wide point. If we're all not in this together, all not working on this, we're never going to achieve the common outcome.
Sure. I think we've got a couple of minutes for questions. So would anyone like to challenge this distinguished panel? Yes, sir.
My name is Amlan Roy, LSE and LCP. I've heard a lot of discussion here, but as a former risk management professor, I like people to define risk. And there are lots of risks. There's operational risk, inflation risk, equity risk, fixed income, private equity risk. And it's not even easy to try to kind of aggregate them, forget about the nice risks that Sonja has talked about. So it's very easy to talk about risks, not very easy to quantify them. I'd like to get some opinions.
We were going to talk a bit more about metrics anyway. Thomas, can I throw that to you first, and then maybe...
Certainly, I think it's an excellent point, is that one of the key elements around risk management is not to over-index on any one particular metric or view, because it's actually a cohabitation of all of those risks, and some may drive your outcomes and some may not at different points in the market.
So actually not to believe that any one metric is the truth. It's an aspect.
No, and even one metric, it's all about context. Is that why are you concerned about it? The sort of the classic sort of 08 mistake is like, let's look at VAR and that'll tell us everything.
Can you give us for example of a metric that works in one sense but not in another?
I think tracking error in fixed income is a very common one to sort of give you the sort of broad brush of where you are, and typically, but the number in and of itself doesn't mean anything because it's reflective of the environment that you're in and the model that you're using. So actually, to the point that we were talking about earlier, is that you've got to stress test yourself in different regimes, because today won't persist forever, and models are generally backward looking. We can use history, we can also use hypothetical versions, but the complete risk management approach is to think of and to challenge yourself to try and think of what am I missing, and in what environments does this work, what environments does it not work. And there's always a sort of we live in a very statistical sort of part of the universe where we think about, well, where do I put the probability of these events outcoming, and then you can put some degree of value on that. But the reality is that there are always new metrics. There are always more ways to look at things.
We could have a whole subject. My particular thing is metrics for behaviour, because metrics tend to be financial and therefore highly sort of derived and remote. Whereas if you're actually watching what people are doing, that's a whole other set. Sonja, maybe you could pick up on that or talk about your new basket of metrics that you're developing.
No, just to add actually that it's the interconnectedness in particular that models very often fail to understand, and how this interconnectedness changes. I think we are not always humble enough that there's many risks we don't know. I mentioned the political risk, that I'm very worried that the market is far too complacent in understanding what the implications might be. As you rightly say, it's always backward looking. We're trying to run models, correlations, and our understanding on the basis of the experience we've had in the past, but we're not spending enough time on the potential risks of the future. And there's a reliance on these models that will not always help you to understand how the landscape will shift. But coming back, the interconnectedness is so important, and it's that piece that normally will drive new risks that we're failing to grasp.
I hate to say the clock is rather against us, so difficult question, but let's do this anyway. If you could do one thing to change or improve downside protection, or that you'd share with this wonderful group we have here, what would that one thing be? Change the way we work.
It would be, I'm coming back, it would be the acknowledgement of the need for a global approach. The harmonization of the thinking at least would help, I think, would help the discussion. But coming back, it's of course the measurability. There's no point just discussing what I believe, but it's the understanding on the assumptions that go into the modeling. But it has to be a lot more forward-looking.
Right. So challenge the assumption, question the integrity of the model. That's excellent life advice generally, actually.
Yeah, you know.
Gail, from your point of view as an auditor and as a city person.
I would add to what Tony said, improve the awareness. Mm-hmm. I think when you read, you know, the amount of money, the $7 trillion a year needed to invest between now and 2030, if it's back to the point, what you can't measure, you can't manage. What people don't know, you can't fix. 14% of all emissions in the UK are from households. How are we all individually in our flats or houses, how are we going to change that? I think it's getting that problem back down to an individual level.
Making that downside personal, really. Yeah. Jeremy, downside, gold.
Well, I mean, I think it's about building the diversification that is needed to be able to weather more than one macroeconomic environment. So I think it's very dangerous to be all into one scenario from a strategic perspective. So what I would kind of highlight to investors is to have a number of those defensive portfolio insurers.
But gold maintains a steady place in that.
Well, gold has a role to play.
Are we allowed to say that?
Has a role to play. High quality bonds has a role to play. There are many different options.
Excellent. And we'll be hearing more about gold, I think, in the next roundtable session as well. Thomas, final thought on what's the best thing we can do for downside protection?
I think never stop questioning what's working, and also looking at kind of the correlations that work for you today may not work for tomorrow. So understanding where you're reliant on the correlations and try and find markers that sort of tell you when you're moving away from that, so that you can be more dynamic. Because I think it's not a click and forget environment. It's very much sort of dynamic, and as the market changes and the market participants are not as rational as the books would have you believe.
So sentience, critical thing. Actually, we've had this with the models, the people, the allocation, and now the interconnectedness. All of those things challenge assumptions and check, be sentient, be thoughtful, be observant. Excellent. Thank you so much to the panel. If we can have a vote of thanks very much indeed to our